What's up guys, James here with Fun Fact of the Day. Hope you guys are having a great day, learning lots, and getting stuff done. Today, we are entering the Twilight Zone, and an episode of Black Mirror, and just Crazy Town, because we are talking about negative interest rate loans. Imagine a place where you went to go buy a house, and the bank actually paid you to take out that loan and buy your house. That is a reality for millions and millions and millions of people right now, all across the Eurozone and Japan. So, we are going to talk about it, and why it even exists in the first place, and how anybody could make money doing this. Now, these negative interest rates, they aren't just for loans. They also apply to bank accounts. Imagine putting your money in a bank account and then paying to keep it there. We'll talk about that tomorrow. And 2 days from now, we're going to talk about negative interest rate yielding bonds, which means you buy a bond, and over time, you will actually lose money on it. Why the heck would people buy these things? But people are buying them by the bucket load, so we're going to talk about why they're doing that 2 days from now. If those two videos are already up when you're watching this, they will have been posted in the corner, probably right about here, as a little shoot across tab. So if those are up, click on them if you want to know more. Now, back to negative interest rate loans. First of all, let's get started with why these could even be a thing in the first place. Well, in order to do that, we need to get an idea of how the economy in Europe has been doing. As many of you may know, in 2008, the economy kind of just took a giant dump and crashed horribly. But in the United States, we have recovered pretty much completely since then. However, Europe doesn't have the same story, and neither does Japan. So, their governments have resorted to extreme measures in order to stimulate their economy. Let's get started with why that even needs to be a thing in the first place. You see, when an economy isn't doing very well, people tend to hold on to their money. They don't know if they're going to lose their job. They don't know when they're going to get more money. It's kind of a scary time. They don't know if their house is going to depreciate more in value. So they tend to not spend money, which then means that the businesses that make money from people buying things also make less money, which then means that those businesses order less products from other businesses. And it becomes a vicious cycle of people not spending money because the economy is bad, which then makes the economy bad because people aren't spending money. It's terrible in every way. So, the government has to figure out a way to combat this. And usually the government's first line of defense when it comes to a collapsing economy is to use what's called the central bank in order to help stimulate that economy by getting more money into your hands. How does it do that, you might ask? Well, the way the banking system works is there usually is some sort of a central government-operated bank in any specific country. In the United States, we have the Federal Reserve, and maybe in Spain they have El Federal Reservo. Who knows? But they all have different names, and they're called a central bank. Their goal is to loan money to other commercial banks, the ones that you and I actually bank at. Now, those banks that we bank at give us money in the form of loans. So think about your credit card, your car, your house. Those are all loans. And when you get them, you have more money to go out and spend on things. And usually people don't just take out loans to roll around in money on their floor or in their bed. Although they might. So how does the central bank convince these other commercial banks to give us more loans and convince us then, in turn, to actually take these loans out? They do it through interest rates. Commercial banks don't actually have enough money to give out all the loans that they need in order to make money and thrive as a bank. So they have to get the money from somewhere, and they get it from the central bank. So let's use an example of this in order to better illustrate how this is going to work. Let's say the central bank is offering all of their money at a 3% interest rate. That means all of the other banks, the commercial banks, are going to withdraw some of that money. They're going to take out a loan at 3% in order to then use that money to give us loans at a slightly higher percentage so that they can make profit on that difference. So maybe they would give it to us at 4%, and then they would make that 1% profit margin. But what happens in these bad times is, in order to promote cheaper money and more loans being taken out, the central banks lower that interest rate. And in this case, they have lowered it all the way below zero to a negative number. When they do that, because of basic market competition, banks are going to have to lower their interest rates because otherwise they won't be able to compete with the other banks. And so they then lower their interest rates proportionally to the rate that has been lowered by the central bank. So if, let's say, the central bank is offering loans to the commercial banks at negative 1%, the regular banks can say, okay, I'll take that negative 1% loan and I'll offer to the public, to you and me, a loan of negative 0.5%. That way they make 0.5% on the loan. It still works the exact same, except for the government ends up taking a hit. They're basically just giving us all money. So what does that mean for you? That means that if you lived in one of these Eurozone countries that currently has negative interest rates, you can go down to a bank right now and get a loan for, let's say, a house, a mortgage, at a negative 0.5% interest rate. And over the next 15 or 30 years, or however long the loan is, the bank will actually end up paying off a small percentage of your principal. But they still make money on it because they paid even less for that loan. Now, whether this severe degree of loan manipulation is actually enough to stimulate economies, that is a hotly debated topic, and I will leave the answer up to you. Because, frankly, it hasn't been around long enough for anybody to know if it works well. So we'll have to see. Now, the real question is going to be, how do these banks get away with charging people for holding their money? Why wouldn't everybody just hold it at their house under their mattress or, stuff it in an old sock drawer? That is tomorrow's video, and if it exists yet, I will put a thing up right here-ish, so you can click on it and check it out. If you didn't absolutely hate this video and you'd like to learn more about everything in the entire world, click the link right here. We've got tons of videos, every one I've ever made, and they talk about everything. Like and subscribe if you haven't already. It really helps the channel grow, and I will see you tomorrow.